How important then, Pranav, is the role of the VC or the investor in engaging with such founders constantly? In a sense, that is a mentor's role also.
A lot of things have changed in 10 years. I will say 10 years back, very few people would have believed that these startups, these toys, these little things that make noise in economic times, whatever, they're one day going to go public. No one believed that to be true. Even early stage VC were hoping that was true, but we didn't know till it's happened, right? So early on, you said, okay, the goal here is growth. The goal here is prove a point. The goal here is show moats. You raise a Series A, Series B. But as the markets change, and as the Indian public markets have very clearly told us, we want more new assets, great businesses to come here. The role of the founder, the role of the shareholder in these private companies, in one day dreaming to go public, that has reached the next level. So what does that role today demand of you? The role today demands even of a seed stage founder to know about governance, to know about business integrity, to know about ESG, to know about one day I need an independent board member. What does that even mean? They need to know all these things on day one. No one is born with that knowledge, right? It's already hard to raise money, raise a seed round, hire your first team, take the risk, compete against a Google or a big Indian company or a bank or whatever. On top of that, you have this burden on the founder. So it's too much. It is too much on any human being. So good investors have started in the early stage laying out this template of what the next 10 years are going to look like, what the next 10 years are going to demand of the founding team, what role we will play in year one as a seed investor is very different from what role we play in year 5 when you raise $100 million if this thing has worked, right? So all of us are evolving our roles as the company goes through this life cycle. Secondly, I think on governance, I will be very pointed. Most founders didn't have to care about governance in the early stages because if you looked at the US, and that's the by far the largest market for innovation globally, $60 trillion market cap, right in the United States, they haven't cared for governance even when they were going public. If you remember Facebook's IPO, it crashed 50% in 6 months. Some reporting was off. There have been all kinds of teething challenges, even for the largest, most sophisticated markets and the biggest tech company. So you understand that, yes, some things take time for a culture to seep in and for everyone to realize that is the true burden that we are building towards. And it's worth it. Because if you show governance, if you meet your guidance, if you manage the market's concerns about your business, they reward you on the upside and you get 60p, 80p, 120p. It clearly shows you that the market believes in your story. And that's why it's worth it. And lastly, I think we've also seen bad actors on cap tables. We've seen a lot of helicopter capital come in and go. Yeah. They'll give you a massive valuation last week and then next year, those people don't even have that job anymore. So who's really answering for this capital, $100 million that just came in? So you had to, as investors and founders who are local and building these businesses, also have to deal with new risks that you didn't even imagine would be a problem. No one would have told me 10 years back, the $100 million coming into your company is a problem. I would have said that's a damn good outcome. That's a great achievement. 5 years later, when the partner who made that deal is no longer in that firm, suddenly, okay, who's answering for this $100 million? That's a problem, right? So I think you learn also along the way. And good investors, good founders care about the business. Because I'll close with this. In the end, the founder is the largest shareholder of that company, right? He starts owning 80-90% or the founding team owns 80-90%. When it works, when they're going IPO, maybe they own 20-25%. But the value of that 20-25% is hundreds or if not billions of dollars, right? So when a founder steps back to think like a shareholder, and when all investors, seed investors, Series A, Series B, whatever, when they think like shareholders, like fiduciaries, like we call formally, everyone knows your incentives are aligned to get the best discipline in and get the company to be the best version of it can be.
Do you agree with this thesis, Rahul?
So in our case, the playbook version of how life will change over the 10-year journey, that itself is a big learning for a founder in the 0 to 1 stage. I mean, they cannot see beyond the 1 year. That's absolutely a dark zone nobody wants to think about. I think what I was thinking when Pranav was saying is that one of the big benefits of IPOs as a legitimate, logical outcome of all the startup journey is now beginning to kind of take hold. That is the most sobering and the most solid, I think, end outcome of everything. So when you tie back everything to an IPO, your valuation needs to make sense. Your organization structure needs to make sense. Your governance needs to make sense. You are not just operating in a Bangalore vacuum of building this very sexy startup, right? So suddenly the lights are going on in a very dark room where what you're seeing at the end of this big hall is an IPO where you're going to be in the public eye and every quarter is going to be a tough quarter. So people are realizing that from here to then is not such a long journey. It's not a something that will happen to somebody else. It'll happen to me. And that, I think, in the last 2-3 years, I've seen do a lot of good. $1 to $100 million valuation. Founders themselves are now asking, can we sustain this at IPO? So not that there are too many investors offering crazy valuations, but that's become actually a internalized logic, which is very different exactly to this point that 100 million made sense to everyone, right? The crazy valuation, take $1 billion, I want to be a unicorn. 21, it was very easy to become a unicorn. You ask and you get, because somebody wanted to put in 100 million, then that's why you become a unicorn, not the other way around. So now I think it's it's so well understood that there are more important things to build and to come back to fundraise at a reasonable valuation, to go out in a public where the public valuations need to be supportive of your last valuation. You can't be dropping off a cliff the moment you list.